Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Good morning, good afternoon, good evening, and welcome to the LiveSquawk preview show. For those regular guests, you know what we're about. LiveSquawk is an audio news service aggregating news for financial market news for our brokers, dealers, traders, anyone interested in up to the second live news. And for those who don't know, please visit livesquawk.com, take out a trial and see if it's something that might aid your trading day. Every week, every time we have a big event, we'll bring you a preview show of said event. Today's one is US non-farm payroll, and again, arguably the biggest number of the month for the trading community. I'm here with guests to discuss and basically preview the data, and hopefully you'll get something from it, and it will help you break down what to look for. I'm joined today by Beat Nussbaumer, founder and CEO of Macro Beat. He's an FX macro trader, researcher and FX tutor, market professional for nearly 40 years, and tweets his own opinions. We've had him on before. We've had a good reaction from every time he's appeared, basically. You know, as I said, as a seasoned professional, what he doesn't know about the markets, the FX markets particularly, isn't really worth knowing. So without any further ado, I'd like to introduce Beat to today's show. And also, really, what we're going to do first is go over what we're looking for from today. So it's US non-farm payroll day, as I mentioned today. And we're looking for the headline rate to come in. And it's moved. It started out around 200,000 for the month of November. It's now up to around 220,000 consensus from 12,000, a paltry 12,000 we saw last month. Unemployment rate expected to come in at 4.1. That's an unchanged read from last time out. Change in private payrolls expected at 205,000. That's from a fall of 28,000 last month. Manufacturing payrolls also expected to rebound to 30,000 from a fall of 46,000. Average hourly earnings expected at 0.3% on the month over month versus 0.4, with the year over year seen at 3.9 versus 4%. The labour force participation rate expected to rise 0.1% to 62.7% from 62.6%. And we have underemployment rate last time around came in at 7.7%. Quick note here from one of the one of the bank desks here. After a soft 12,000 increase in employment in October, we expect 155,000 rebound in non-farm payrolls in November, reflecting a bounce back from strikes and hurricanes that weighed on employment over last month, but a still softening underlying trend. Even before weakness in October, the average pace of private services job growth had slowed to just over 100,000 jobs per month over 6 months, cited Citi analysts. We expect this weakening trend to continue as estimated payroll employment comes closer in line with already much lower levels of true payroll employment, as evidenced by the Q2 QCEW data. We pencil in 100,000 odd private jobs in November, but with the trend still slowing after averaging through October and November. And with that, Beat, just like to bring you in on this. What do you look for out of today's number? I mean, obviously, we're looking for this thing to rebound after such as a soft reading last month. But in terms of expectations, we're going to have to see something drastic, like a sub, what would you say, 175, 150 reading, and I guess above a stronger 250 to get any kind of proper reaction, I guess.
Yes. Hi, Harry, and thanks for having me again. Really a pleasure to be on here again to chat about the non-farm payrolls. Firstly, I would say we also have to probably consider the time of year. having a December, we're getting a near year end. I think some of the bigger accounts may just slow down in terms of fresh risk, taking fresh view at the market. I would also suggest, we have the Fed meeting on the 18th, and I think we're sort of baking in the 25 basis points cut. And I don't think that the number today will really shift that needle unless it's crazy one way or another, or basically on the upside for a pause. Personally, I think the way I look at it today is weak and strong is a blip, if that makes sense.
Okay.
I think we have an underlying, we've seen actually, especially this week is the first time we started to see weaker data coming through the ISMs and some of the other data. So the US data surprise index has definitely peaked. It's gone up like from summer. That's why the euro peaked at 112, and now the whole thing seems to change a little bit. We hear a lot about job cuts that are in the pipeline. So I think no matter what the number is today, I think the overall trends, I would agree with that bank report you said there, that the overall trend is lower no matter what the number is today. It's November, it's Thanksgiving, so it's always a bit tricky. You can have these sort of seasonal impact. You already mentioned the hurricane stuff and the strikes that are coming back. So I think it's noise. I expect this to be a lot of noise. I personally felt I'd be trading, I have some core risk, which I'm not going to change for non-farm payroll data. But for what I would be trading on the days, I would definitely trade a weak number by selling dollar yen or just selling dollars. Dollar yen probably in particular. On the other hand, if we get like a crazy 250 number or whatever, whether I trade it or not with buying some dollars, I don't know. So I have an inkling that I'd much rather trade a weaker number or disappointment. And on a strong number, I try to fade whatever move we get. I think a strong number will see a few hours of fun. Maybe it sort of drags into early next week, but I wouldn't be surprised if a strong number would be forgotten very quickly, while a weak number would not. So the other thing maybe to mention, I think the market is just, and we have seen it in the last few weeks, it's just overwhelmed with news. We have Russia, we have the tariffs, we have the sort of weak European data, we have Trump starting to nominate people, we have the best story that obviously peaked, US yields, so the 10-year up at 450. And then we have so much news that this may all be a little bit different than other year ends.
Right.
I think that maybe 2025, if I just may quickly go past today's non-farm payroll number, is maybe the year starts on January 21st is in 2025, not on the January the 1st. So I think there's so much stuff out there I really do not expect the market to rethink the world on today's payroll number. I think there's just other moving parts out there right now that may diminish the reaction a little bit. To be honest, I'm still up for a punt if we get let's say, as you pointed out, probably sub 175, sub 150 will probably be seen as weak, because the market generally probably expects a higher number.
Well, that will confirm the narrative we were talking about, I guess.
Yeah, exactly. And so if we suddenly would get something like sub 100, which we don't really expect, as I said, dollar yen would just crater. Dollar yen is already very vulnerable overall because we have the BOJ story, we have the tariff story, and so I think the dollar yen is really on the edge. That if you mix in weak US data now, I think that could be really the bigger move. And so if you get a stronger number and the market feels he wants to buy dollar on it, would be my guess. I'd be waiting in the wings to sell it.
So, I mean, effectively what you're saying is, and listen, you've seen however many number of these non-farms, and you've been around, as I said, for the last 40 years. So this time of year is I guess, just a tough time to trade. And like you said, many of the bank desks, their books, they've either made their money or not for this quarter or this part of the year. They're not going to risk that over a non-farm payroll number. Right. So therefore, they're on the sidelines for the most part, I guess, unless there is some monumental shift. So then we're looking at a more volatile event, really, that is more about the locals, more about the intraday traders in total. Yeah,
I would say it's really, like non-farm payroll often is, it's a few hours of fun with all the short-term adjustments or the short-term punts that people do. But I doubt that at this time of year someone would just rethink the whole world. So I don't think it's going to go for bigger shifts unless, like I said, weak is weak. That's really my core view about this.
Yeah.
Strong I might ignore, weak is weak, and weak I trade.
Yeah, fair enough. That's a good point. Just to give you a bit more on this, that I'll put it down as extraneous factors. HSBC add into this, again, the noise that we're likely to see within the number itself. The state data on non-farm payrolls for October released on 12th of November, and it showed that 35,900 decline in payrolls from the state of Washington, highlighting once again that the likely impact of the earlier Boeing strike. The data also showed a 38,000 decline in payrolls for the state of Florida, again, likely highlighting the disruptive impact from hurricanes. This is from bank analysts. It's worth noting, they say, highlighting that the sum of states showed a sizable 76,000 decline in October, considerably lower than the 12,000 outcome in the national data. And this is important because it shows that more weakness in the state data in October, even outside of Washington and Florida, and creates uncertainty about the extent to which a bounce back might occur in November. That was from HSBC. So everyone, I think, if the leaning, and from what you said and what we've heard from two, prominent bank research desks, is they're all looking for this weakening trend to continue, and therefore justifying December's likely 25 basis point rate cut. And on that note, if we bring in comments from Powell this week, who said, he's not countering that, I guess, but it's kind of, you've had comments from Powell that says we can afford to be more cautious with monetary policy going forward. You had Fed's Muslim says expects more rate cuts, but says easing path is less clear. Barkin was encouraged by direction of inflation. All this appears to be saying, look, we've made some adjustments to policy. We've brought in, we've had rate cuts so far in the latest cycle, but we want to see what happens from here on in. As you said, it would take a severe weakening for you to think they go more than 25 basis points anyway in December, but there's a high bar for them not to cut at all.
Yeah, to be honest, I think the reaction was quite interesting when Powell spoke. Probably Powell had like two sort of micro hawkish comments in there compared to before. I think the dollar rallied briefly, and then it was just over in like 2 minutes, and like fixed income was just, US yields continued to really sell off. 10-year just sort of continued to grind lower because the market really felt, rightly so, I think, that Powell had the chance to push back. Because I think, can't remember the odds are, but probably around 70% for a 25 basis points cut. And so I would think Powell would have needed to use different words if he really wanted to push back. So I would be shocked if there is a pause. I think the pace of cuts, if the Fed is really thinking the economy remains strong and the slowdown is very slow, so that they, there's plenty of time going into 2025. To then sort of, slow down a little bit or pause. I think right now, we argued this many times. There's a lot of, inflation criers out there, re-acceleration, blah, blah, blah. Maybe it might. But I think for me, it was important how long the Fed stood pat while the inflation came off. So rates at 5.25 at the time just didn't make any sense anymore where inflation is right now. And so another 25 basis point cut doesn't really spoil the party, and you can still then pause after that. On the other side, there is no chance, no matter what non-farm payroll will be today, that it would shift to a 50. I think 25 is maybe a bit touch and go. You could argue, could they pause? Yes, they could. Should they cut? There's not really a need, but it's not an accident if they do. So I think they just go ahead with the program, may slow down into 2025. I think they still haven't really made a lot of comments, understandably so, about any impact that the Trump presidency will have, be it on the tariffs, be it on, a lot of the migration stuff. Who knows? Like, just call it just Trump, rather than go into the details. So I think the Fed will definitely review what will come after January 21. And so I think to bring in now a cut, and then they already know that maybe they have to pause after that, just to condense and see what the new administration is all about and what the possible impact will be on inflation, growth, or elsewhere. So I think 25 is done, no matter what payroll will be today.
Yeah, fair enough. I want to sort of expand on what we're looking at really in terms of other central banks and so forth. Just want to finish on this Trump aspect. He was very robust in his assertion that he wanted to try and drive illegal immigrants out of the US. Obviously, the inauguration's on the 20th of January. Even if they get cracking on that, that's going to take a while. But some expect some feed through into the labour market on that, and potentially on inflation if you're taking out all the cheap labour basically that currently exists in the workforce from illegal immigration, and the impacts that has on the jobs, on the job outlook really. But just to put that out there, really. But his inauguration's on January the 20th, and I agree. I think you get one more in, and then you have to take a stand back and look at what's left, what he brings in, what he does in his under this new administration in the first few months of 2025. Widening out now monetary policy. And if we look, we heard from Dingra from the Bank of England. She was one of the more. She is the most dovish member of the MPC anyway, and so we're looking at wider central banks and the ECB. What are your views on the ECB in the near term? Do you think all this talk about a 50 basis point cut was overblown as well, or do you see any real justification for going more than 25 basis points at the next meeting?
Yeah, to be honest, the key with ECB is really, if we think about the ECB like the Fed, you could argue, okay, 50 would be justified on some level, but then we forget one thing. The ECB has a single mandate, while the Fed has a dual mandate. So ECB has just an inflation mandate. So all the people that talk about, they front run, grow issues, weak data, tariff risk, blah, 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 blah. I think missing the point here that you have a central bank that is built, wrongly probably, but for the time being, is built around a single mandate. The inflation, as we both know, has been a little bit stickier of late. Trend is okay, but it's been a bit sticky. So, the data has sort of, let's say, data was, really, really bad, and Germany looks like really worrying. But the deterioration has sort of slowed down a little bit. I think from all the comments I sort of picked up in the last few weeks, I would say we're gearing at 25 basis points. I think for next year, it'd be maybe if the pace would be changing. But I think if they would be cutting 50, I think it would actually be more of a shock and sending maybe a wrong signal to the market in a sense of a panic. We know the problems, right? The market is not stupid. We know what the issues are. We know there's a tariff risk for Europe. We know that there's a data is not looking great. We see that Germany struggles to rebound. We have the issues in France. We have early election in Germany in January or February. So there's a lot of moving parts. So I think from a pure ECB point of view of the single mandate, I cannot see anything else than 25 basis points. I really don't. I think 50 would be a shock.
Yeah, there's also that argument about restrictiveness, though, and the fact that how restrictive are, is it still ultra restrictive at the moment for policy? And that's, I guess, an argument. I mean, I've got a piece here from Barclays that says ECB set to continue its sequential easing with a 25 basis point cut in December. We expect we being Barclays, expect a softer tone on restrictiveness, though not signalling leaving restriction yet. Its new forecast should show earlier inflation convergence to target and lower 2025 growth due to higher policy uncertainty, which reflects on what you said with German elections coming up in February and the ongoing French situation. You've got the two largest economies within the Eurozone looking like a mess at the moment, and that doesn't help confidence. That doesn't help, expectations for growth, I guess, and it's left on the other countries. Funny enough, when you look at Greek yields and where they are compared to France, where they were. Who would have thought? But even Greece, with GDP data out today for Q3, it fell off quite considerably from the second quarter. So even in some of these peripheral states, the growth momentum isn't really there.
To be honest, I think what you could see, not saying that there's a major overhaul, but in the last, since the existence of the ECB and the euro, we always talked about a very strong hardcore euro,
Yeah.
Germany, all these sort of hardcore countries. And suddenly, so the single mandate didn't actually matter. Suddenly you have like Germany as one of the weaker ones. You have like, we always said in the last few years, we said the next big shoe to drop might actually be France. And if that shoe drops, that one is not so easy to just discuss away like we may have done with Greece.
Sure.
So I'm not, forecasting the next major crisis in Europe, but just to say, suddenly the ECB is faced with, I'm sure behind closed door they wouldn't mind to have a dual mandate. Suddenly, right? Because we have like the biggest two economies struggle, and the biggest one is really, on its knees compared to historical standards since the ECB exists. So I wonder if there is, to be honest, I'm not an expert on that front, how quickly such an overhaul could take place. But maybe the ECB, as you rightly point out about all the issues that are going into 2025, may actually have just to look through that inflation issue and just try to get all those hawks on board. Interestingly, if you look at the bigger hawks in the ECB, they have actually all sort of talked more on the like for their standards, they were dovish, right?
Yeah.
So the cuts are definitely there, so they see that it's needed. They may not just yet be on board on the pace, the size or the pace of cuts, but I think even the ultra hawks start to understand there's a problem.
Understood. Okay. Just to note, again, we touched on the Bank of England. Again, it's less of a story at the moment. There's the word gradual is very much part of the narrative there, as I said. And we had Dinger on today, Uber Dove, with comments. We won't go over that too much. Coming into year end, and we're going to have a year end show that takes a look at the bank research and the outlook for 2025. But just generally, from your perspective as a trader, as someone who looks at these markets on a daily basis, when do you start? What's your, I guess, pattern now between now and say New Year? How do you avoid, having a horrible December when there's less liquidity out there and ever decreasing days in which to trade?
Yeah. To be honest, what I already did is thanks to some of the bigger moves we saw of late, which suited my sort of core risk of like the long yen story, I reduced core risk and shifted, because luckily I've been 20 years a spot trader, 20 years of a macro trader, so I can sort of use both sides of the calendar, I hope. So I have started to already adjust to more short-term trading. I think the dollar is going to be a question mark for some time. I don't think there's a big story in the dollar as in regard to euro dollar. I think the yen story is an interesting one still, because you have like BOJ coming, which I think is live. For the December meeting. So this divergence or convergence, so to speak, on rates as BOJ continue to normalize policy versus the rest is cutting, that starts to hit home. Why? Because you also have the tariff threat hanging in the wings, which is the traditional risk-off element, as we have seen in 2018 when Trump started the trade war with China. So there's this whole yen element, the carry element. The market will be very nervous going into year end. We had a few examples how quickly dollar yen has come off in the last 2 weeks. It's no coincidence, I think. It's a lot of positioning out there on the US side from model funds that probably squared up stuff. So I would definitely be prepared that it could really get messy, because I actually feel the market is already a lot thinner than it usually is.
Right.
So I think people should really be careful in terms of their risk management, that, December is like summer markets. It can just run and run again. So it's not, you don't want to fade a December mark. But generally, I think that the yen is probably interesting into year end. The euro could be a little bit of a snooze, or the dollar as such could be a bit of a snooze. The Aussie is a bit on my radar. It's extremely weak. You see it in the crosses. You just see like this China issue is really weighing on the Aussie. And surprisingly, if you think that the RBA is the only one that hasn't cut yet, it might not cut until April of next year, and Aussie is still underperforming. Even Euro Aussie has rallied a lot in the last few days, which is about the last one you would expect. But there's a lot of uncertainty on the risk side, risk effects, as in tariffs, geopolitical. So I think for me in December, I have like one core view, which is I'm ultra bear on sterling against what Bank of America sent out today. But we might talk about this on another day. But other than that, I think trading the market rather than trying to have the biggest views out here. I think between now and Trump inauguration, you just have to be a bit more flexible than usual, I feel.
Sound words. Thank you. Right, we're coming to the end of the show, so I want to thank you, Pete, for, as I said, your wise words. And
pleasure to be here, Harry.
No, it's valued. As I said, you've vast amount of experience working for some of the biggest institutions, biggest banks in the world, and so you've been there at the coalface with the where what we call the paper institutional clients would be, and so it's always interesting to hear your viewpoint really now as a sort of intraday trader, and like you say, you're now a bit more short-termist in the near term. So thank you very much. I'll put your links up again once I've finished the show. Also, no, pleasure. But just to quickly go over the numbers again for the audience. Today, non-farm payroll, again, we're going to look, it would take a lot for this, I think, for us to see any monumental sort of shift in monetary policy expectations. But so expectations are for non-farm payrolls, consensus is 220,000 from 12,000 gain last month, obviously heavily affected by weather and strike action. The 2-month payroll net revision last month came in falling by 112,000. Private payroll is expected to rebound to 205,000 from a drop of 28,000. Manufacturing payrolls expected to come in up 30,000 from a fall of 46,000. Unemployment rate to stay on hold at 4.1%. Average hourly earnings on the month seen at 0.3%, dropping a tenth from 0.4. Average hourly earnings year over year also seen down a tenth to 3.9 versus 4%, with average weekly hours all employees seen at 34.3 unchanged. Participation rate seen at 62.7, up a tenth from 62.6. And last month we saw underemployment at 7.7%. Don't forget, we've got University of Michigan December prelim out later on as well. That's expected to improve. We'll also see at half past the hour Canadian jobs data as well. Net change expected to be up 25,000. That's some 5,500 up from last month, if those numbers are to be believed. Just the final word then, again, just note that none of the information shared today should be considered as financial investment or trading advice. Again, we are simply here to give you a bit of a heads up and an overview of what's coming. So please take that in mind. And also, if you want to trial the service, if you go to livesquawk.com and click on free trial, get a week's free trial of the service. If you hurry up, you might even get in time for today's non-farm number in about 45 minutes from now. Thank you very much for listening. We'll be back again before year end, obviously, because we've got December FOMC. We'll have guests on for that, and we'll do a year end wrap, and we'll look at some of the bank research looking at 2025 forecasts. So please join us again for that. livesquawk.com. Thank you very much, B. Thank you very much for listening, guys. Thanks for tuning into the LifeSquawk podcast. Your edge in the market starts here. Subscribe now.